John Nadler, Freeport-McMoRan is buying 2 oil and natural gas drillers. What does this mean for the precious metals market?
Well, look, it's a stunner, first of all, and my perception is it'll end up hurting metals investors in that niche, particularly in the equities side of the business. In an era when CEO heads are rolling by the week, people are scrambling to find something that'll make money. Analysts are stunned. Obviously, the share lost 16% yesterday. It kind of harks to the days of when Standard Oil bought copper assets. But at the end of the day, the strategy isn't there. The cost savings aren't there. And I think it shows that, if you can't make money at the basic core business here, what are you doing in strange niches? Obviously, the CEOs and others on the board benefited from this deal because there's some conflicts of interest in ownership terms of other assets. But when you look at the bigger picture, consider, Vedanta Resources, which not that long ago bought some energy assets in India, and its shares eventually ended up falling nearly 50%. So I'm skeptical of this deal, and I think it reflects somewhat of a desperate move.
The other big news of the week is Goldman Sachs' call that gold has topped out. What's your view of that?
Well, Goldman said, yes, the top is in, and we may see a little bit of a, ratcheting up sometime before middle of next year. But thereafter, they see a gradual decline that should last years. And this is very important because, it's the first major turn in the market in more than 12 years, nearly 14 years. Goldman, by the way, is not alone in calling for this turn. Deutsche Bank is also saying that gold price will be range bound at best next year. BNP Paribas is actually calling for that similar turn as did Goldman, scaled back its forecast to the mid 1700s. And the basic premise for all of these trimmed or lowered forecasts is a turn in the environment for real interest rates. They're basically telling us that the hyperinflation play did not pan out. They're basically telling us that the Treasury bears, PIMCO, Peter Schiff, and so on, are dead wrong, and they're betting against the firepower of Bernanke and the Fed, and that a gradual improvement in U.S. economic metrics will bring along this shift in real interest rates, which obviously cannot benefit gold. But look, this doesn't mean you go sell everything you have in gold. If you have profitable chips to cash in, fine. Funds are doing it already, as we can see these days, but a core long-term holder can safely stick with 5 or 10% if they feel that there's some insurance necessary for the future. It's an interesting development. We should keep a close eye on it as we get into the second half of next year specifically.